Welcome back to Learn SKN, and today we're going to continue looking at the May-June 20 or the July 2021 Econ Paper 2, right? We're going to look at the 2021 Econ Paper 2. We would have completed questions 1, 2, and 3 already, and so today we are looking at question 4. But before we jump into the question 4, you know what to do. Like the video, subscribe to the channel, and hit that bell so you know when Learn SKN drops question 5, maybe next paper, or maybe the paper 1 for 2021, but you're only going to know if you hit the bell, right? Share the content, share the papers, share everything with all of your friends. Don't be all about yourself, all right? So let's just jump right into question number 4. And it starts out asking us to list 3 examples of each of the following concepts. List 3 examples of each of the following concepts. And so we are listing, and so therefore we're just looking for 1, 2, 3, 1, 2, 3, and that's it. You don't even need sentences per se because we're listing here. And so for financial institutions, we have, of course, if you go to our textbook, we have a whole bunch here laid out. So you have the commercial bank, you have the stock market, stock exchange, you have credit unions, you have development bank, you have insurance company, mutual fund, building society, investment trust company. Those are all examples of financial institutions. All those are part of the financial system. Some of them are intermediaries between the borrower and the lender. So all those make up part of the financial system, and they are financial institutions, right? So you take any 3, list them, and you have your answers. And then the next question asks us to look for financial instruments, right? So we have to list 3 examples of financial instruments. And so once again, our textbook has it right here. Financial instruments right there. That's what, chapter 15. So we scroll down, we see a whole bunch of them. You have your treasury bills, your treasury bonds, your corporate bonds, your municipal bonds, your equity security like stocks and shares and things like that. Of course, you also have various examples of securities such as, money and things like that, right? So financial instruments, you have a whole list right there that you can choose from. So you choose any of those 3 and you would be covered when looking at the financial instruments for that simple question. 3 easy marks in my humble opinion. 3 easy marks right there. Okay, what is the next question asking us now? So it's asking us there are 4 tools which a central bank may use as part of a country's monetary policy to control the supply of money. Explain the specific action the central bank may take to increase the supply of money using these 4 tools. Okay, so now they are telling us what they want out of these tools. They want us to increase the money supply, right? I am afraid this one is going to be a big answer one. 8 marks, of course, as expected, because this one kind of involved. This question is kind of involved, right? So let's look at what the 4 tools are, and then we're going to see how we can utilize these tools to increase the money supply, right? So let's see. And so here in our textbook, we have some tools that the government can use, right, to influence the money supply. Remember, monetary policy is all about influencing, manipulating, and influencing the money supply to achieve certain economic objectives. And so one way they can do that is interest rates. They can manipulate the interest rates, and so that could influence the money supply. But they say they want to increase the money supply, right? So as it relates to interest rates, what they would do is they would lower the rate at which they're lending money to the commercial banks, and so that would in turn reduce their interest rates, the interest rates that they want to lend you money to the public. And so if the commercial banks have a lower interest rates for loans, that means not everybody, but more people are gonna go and obtain loans because money is cheaper now. Loans are easier to repay, they are cheaper. So instead of having to repay, let's say 10%, you're paying a 5% on the loan. So that's more alluring. And so that would cause more and more persons to take a loan to build a house, take a loan to buy a car, take a loan to do other things. So those low interest rate loans would put more money in the out there in circulation. They will increase the money supply just like that, with the loans being relatively cheaper, right? And so that would impact the interest rate, and that would impact the money supply, right? So interest rate. So central banks lends to financially sound deposit money banks at most favorable rate of interest, right? Called the minimum rediscount rate. Some people call it the repo rate. And so that would affect the supply of credit. And if it's a low interest, the credit would be cheaper. And as such, there will be more money circulating in the economy, right? More loans, more money circulating in the economy. So that's one, manipulating the interest rates. So the interest rate is a tool that they can use. Then we have what we call open market operations. Open market operations. Now what this is, remember again, keep focus here that we're looking at increasing the money supply. So we want to put more money out there in the money supply, in circulation. So open market operations involves the buying and selling of government securities like treasury bonds, treasury bills. The buying and selling. So if the government wants to increase the money supply, what they would do is buy treasury bills, buy bonds from the holders. So that when I buy the bonds from the holders, I give them money. And so when they get that money in their hand, that can be used to do whatever they want in the economy. And so that is pumping money into the economy when they buy treasury bills or treasury bonds. When they buy them back, right, that helps to increase the money supply, right? That helps to increase the money supply. Look what they say here. Reflationary monetary policy. So all these are reflationary monetary policy. They want to increase the money supply. This is a buying and selling of government securities. That's open market operations. When the government buys back securities from the holders of these securities, the government pays them money, which increases the money supply. So you see it right there, right? So buying the securities. Again, the one with the interest rate. When interest rates fall, individuals save less and spend more. They also borrow to make purchases, and this increases the money supply. So that's two. Next one, reducing the required reserve ratio. That way, so here's this go now. Remember, we look at the requirement ratio. We said that every single commercial bank, they must keep back some of their monies. They cannot lend out all the money. They must keep some of the money with the central bank. Or the central bank tell them you must keep back, let's say, 10%, 5%, 50% of your deposits. You must keep that back. Now, if the government wants to increase the money supply, what they will do is lower the amount of money the banks are required to keep. So when they lower that, that means that the banks got more leeway for lending. So more money to lend. Right? So they say here, all banks are required by law to keep a certain percentage of their deposits as reserves. The lower the reserve requirement, the more banks can lend and the greater the money supply will be. So the central bank will say, okay, instead of keeping back 50% of your deposit, just hold back 25%. So now that puts more money out there in the bank for them to loan to people, and that would increase the money supply. So that's open market, that's reducing the reserve requirement. And then in the textbook they have here, improving the availability of credit, right? And so what they're saying here is that the central bank, the government, can find ways to improve the availability of credit within the economy. They say here, by decreasing the down payment needed and increasing repayment periods of loans. So remember again, banks borrow from the central bank at times. And so what they would do is decrease the down payment that the bank need, what they have to keep back, and maybe increase the repayment period of the loan. Sometimes they have to do it in extended the period. And what this means is that again, the banks would have more money available to allow for more lending. Now there are others, there are other tools, there are whole other tools, right? One such tool is what we call moral suasion. Moral suasion, meaning the central bank can try to persuade commercial banks to take certain courses of action that can increase the money supply, right? Take certain courses of action. For example, they might want to encourage these commercial banks to lend more, give more loans, reduce the interest rate, things like that, right? So moral suasion is simply the bank trying to advise, trying to persuade, using their influence to have these commercial banks do something that they wish, right? Expand credit, you know, reduce your this, do that, have a promotion, that kind of stuff. Just encourage them. They don't have to do it, right? Because they are private entity either way. But the development bank, not development, the central bank can encourage certain behaviors of the commercial banks, right? And so you choose any of those from the textbook or wherever, and you would be able to get your full marks for that one. All right, next question. Using the information in table 1, calculate each of the following types of money. Show all workings. So we have money here, right? So we have the money here. We have different assets. We have cash in the bank vaults, cash held by the public, treasury bills, demand deposits, savings and account deposits, certificates of deposits. So what they want us to do here now is basically calculate M0, or the money base, M1, that's narrow money, and M2, that's broad money. And so how do we calculate this thing here now? Now what is M0, M1, M2? Now if you turn to our textbooks, as I've said before, it needed a little updating. So right now they only have M1 and M2, right? So M1, that's narrow money, consists of all notes and coins in circulation, all deposits on which checks can be drawn, and travelers' checks. So that's M1. What is M2? Broad money. That's M2 as broad money consists of M1 plus savings, saving accounts in the financial institutions, and money market accounts. So that's broad money, or M2, right? And so we look at this little flowchart here to show the money supply. But now they're asking us for M0. What is M0? Now M0, another name for M0 would be the money base. I mean zero. That's where everything starts from, the money base. So that's basically just notes and coins, the money base. Alright, so that's the money base right there. So definition, M0 is also called narrow money in some cases, monetary base, high-powered money. This is the currency in circulation. It consists of notes and coins, and in some cases, commercial bank deposits held by the central bank. So for now, just for our question alone, we are going to be looking at what we have here. Cash in the bank vaults, cash held by the public. So that's basically what we're looking at here. The cash in the bank vaults, cash in the general held by the public. We look at the hard cash, the notes and the coins. That's the most liquid type of cash we have right there. So we see here we have 200 million for cash in bank vaults and 100 million for cash held by the public. So that's what's in circulation, right? So we have the 100 million plus the 200 million, and so that would give us 300 million naturally. So that would be our M0. Our M0 would be 300 million. That's 100 million plus 200 million gives us 300 million. That's M0. M1 will be all of that plus demand deposits. And so that the 300 million plus 250 million. The 300 million plus the 250 million. So we got that because demand deposit is right here. 250 million plus the M0, which would be the 200 and the 100 plus the 250, and that would give us our M1, which is 550 million. 550 million. And our M2, which is broad money, it consists of M1, M0 plus the 305 million, which consists of savings account deposits, right? Savings account deposits. So that's where our broad money comes in. So that's saving deposits plus what we already calculated before, which was 550 million plus the 305 million, and that gives us 855 million, right? So that's what the answers are for that particular question, M0, M1, and M2. And just like that, we would have completed that question. 2 marks each, just like that. 20 marks for number 4 for the May-June or June-July, whichever one you want to call it, 2021 Econ exam. Alright, so we're going to stay here for now. You know what to do. Like the video, subscribe to the channel, and hit the bell so you know when Learn SKN drops number 5, which is the last question on this particular paper. Alright, so that's it for now. Thanks for watching. Thanks for listening.